Imagine waking up one morning and discovering that the foundation of the global financial system, something you've lived with your entire life, is suddenly being rewritten. What would that mean for your savings, your investments, your future? Today, we're diving into one of the biggest economic shocks of the century: Saudi Arabia officially ending the petrodollar system, a move that has sent shockwaves through global markets, sparked a $7 trillion revaluation in commodities and currencies, and triggered a scramble for safe haven assets like gold and silver. If you've ever wondered why the price of precious metals is suddenly surging, why currencies like the US dollar are weakening, or why geopolitical alliances are shifting before our eyes, this video breaks it all down in clear, relatable terms that even a complete beginner can understand. Let's start at the beginning. What exactly is the petrodollar? For more than 50 years, since the early 1970s, the petrodollar system has been a cornerstone of the global economy. In simple language, it means that oil, the world's most traded commodity, has historically been priced and sold exclusively in US dollars. Countries buying oil needed dollars, so they held large reserves of US currency, which helped maintain global demand for the dollar, and by extension, US economic influence. In exchange for this arrangement, the United States offered security partnerships and arms deals to key oil-producing nations, most notably Saudi Arabia. This was not just economics, it was geopolitics writ large. Now imagine that system suddenly unravels. That's what just happened. Saudi Arabia, OPEC's largest producer and the world's most influential oil exporter, announced it will no longer require oil sales to be transacted in US dollars. Instead, Riyadh is moving toward a multi-currency pricing mechanism that includes the euro, yuan, and potentially other currencies tied to emerging market trade. This is not a subtle shift. This is a tectonic realignment of global trade. And when oil, the backbone of modern industry, is no longer anchored to the dollar, it weakens the dollar's global reserve status. The immediate consequence: financial markets reeled, with an estimated $7 trillion impact across commodities, foreign exchange, and stock markets worldwide. But why does this matter to you? Because the petrodollar system didn't just benefit governments. It shaped the global investment landscape for decades. The US dollar's strength made American debt attractive, kept global interest rates lower, and created a predictable environment for multinational corporations. When that system shifts, it creates uncertainty, and in finance, uncertainty equals volatility. Investors hate unpredictability, so they rush to assets perceived as safe havens, like precious metals. That's why gold, long revered as a store of value, is once again climbing toward record highs. When we talk about gold here, we're not just talking about jewelry or something that makes a ring shiny. Gold is a monetary metal, historically used as a currency and a hedge against inflation and currency debasement. Silver, platinum, and palladium also respond to these market tremors, though each behaves a bit differently based on industrial demand and supply dynamics. To put this into context, think of the dollar as the world's biggest dam holding back a river of capital. For decades, that dam worked well, keeping markets stable, currencies convertible, and global trade fluid. But now cracks are forming. With Saudi Arabia stepping away from the dollar, foreign governments and institutional investors are reevaluating their reserve allocations. Some are increasing holdings in the euro, the Chinese yuan, and even digital currencies issued by central banks. Others are turning toward tangible assets like gold bars, coins, and mining stocks. This isn't just theory. Central banks in Asia and the Middle East have been net buyers of gold for the past several years, accumulating thousands of tons. Their reasoning is simple: diversify away from dollar-centric risk. Here's a key point: markets are forward-looking. Traders and institutional players don't wait for an event. They price it in as soon as they believe it's real. So the fact that we're seeing such dramatic movement before any formal global cue, currency realignment shows just how powerful this announcement has been. The $7 trillion shock isn't a single loss. It's a recalibration of asset values globally. Stocks tied to energy, commodities, and emerging market currencies saw sharp gains. U.S. Treasury yields, already ridden with inflation concerns, floated unevenly as traders weighed future demand for dollar-denominated debt. Meanwhile, precious metals climbed as investors looked for protection against currency devaluation. Now let's talk about what this means for everyday investors. If you're holding dollars in cash or dollar-based investments, you're now exposed to potential purchasing power erosion. That's where terms like inflation hedge and safe haven come into play. An inflation hedge is an investment that historically maintains or increases its value when the purchasing power of money falls. Gold has often played that role. When currencies weaken, gold tends to strengthen. Silver, too, though it has more industrial demand and therefore more price volatility. Understanding these distinctions is crucial as markets realign. It's not just about owning metals. It's about understanding why investors want them and how their values may shift in a changing monetary landscape. And let's not forget the human element. Geopolitical trust and economic policy are deeply intertwined. The petrodollar era reflected a mutual confidence between oil producers and the United States. When that understanding erodes, it's not just numbers in a chart. It represents shifting alliances, emerging economic blocs, and new centers of influence. For decades, U.S. policy was guided in part by maintaining dollar dominance. Now, nations are exploring alternatives that could reduce their reliance on American financial systems. That's not an overnight change. It's likely to unfold over years. But this announcement accelerates the timeline dramatically. Many analysts are now asking, could we see a new global reserve currency system? Will gold or a basket of currencies replace the dollar's primacy? These questions are no longer hypothetical. They're central to financial planning at the highest levels. The immediate ripple effects across markets became impossible to ignore. Stocks tied to energy and commodities surged as traders recalculated profit margins and future demand scenarios, while currencies once considered stable began showing unprecedented volatility. The euro, yuan, and even some emerging market currencies saw sudden appreciation against the dollar, signaling a rebalancing of international purchasing power. Think about it like a giant game of musical chairs. As Saudi Arabia exits the dollar-based system, everyone is scrambling to find a new seat of security, and for many, that seat is precious metals or diversified currency reserves. But this isn't just a short-term trading opportunity. It's a structural shift that will play out over months and years, influencing how corporations, governments, and even individual investors plan their finances. To understand the magnitude of this 7 trillion shock, consider the scale of global oil trade. Roughly 100 million barrels of oil are traded daily, and for decades, every single one of those barrels required dollars. That means billions in daily transactions, all feeding back into dollar demand and maintaining its global reserve status. With Saudi Arabia moving to a multi-currency system, the dollar loses a cornerstone of its artificial strength. Suddenly, foreign governments no longer need to hold as many dollars, U.S. treasuries may face lower demand, and the very interest rates that have fueled decades of borrowing and investment could rise unpredictably. It's as if the foundation beneath the world's financial house is shifting, and everyone inside has to adjust, or risk being caught off balance. Let's put it in a more relatable perspective. Imagine a massive cruise ship powered by oil, with the engine running on dollars. For 50 years, the engine has hummed smoothly, keeping the ship stable and on course. Now the ship's fuel is suddenly available in multiple currencies, and the operators can choose which one to use. That introduces uncertainty into the engine's efficiency and maintenance costs. Some parts of the ship may adapt quickly, others will struggle, and the passengers, everyone with financial exposure, have to brace for turbulence. This is precisely what's happening across stock markets, commodity prices, and currencies. The ship isn't inking, but its path is now unpredictable, and savvy investors are looking for lifeboats. Those lifeboats historically have been gold and silver. Gold is universally recognized as a store of value, with over 5,000 years of monetary history. Silver, while more volatile due to its industrial applications, often amplifies gold trends in times of crisis. Currently, gold is testing price levels last seen during major inflationary shocks, while silver is experiencing wild swings that reward strategic positioning. But it's not just about metals themselves. Mining companies, ETFs, and futures contracts tied to precious metals have also become key instruments for hedging risk. For the average investor, understanding the nuances of each option, physical bars versus paper holdings, spot prices versus futures, liquidity considerations, can make a huge difference in both risk and potential reward. Another layer to consider is central bank behavior. For years, the U.S. Federal Reserve and other central banks relied on predictable foreign demand for dollars to support monetary policy. Now, with Saudi Arabia's announcement, central banks around the world are reassessing their currency allocations. Some are accelerating gold purchases, while others are experimenting with digital currencies backed by tangible assets. This diversification is more than a hedge. It's a strategic move to reduce vulnerability in a world where the dollar may no longer be the default settlement currency for energy or global trade. The implications reach beyond finance, geopolitical influence, defense policy, and international diplomacy are all affected when one currency loses its global primacy. We also need to consider market psychology. The petrodollar system created decades of confidence and stability. When that stability is disrupted, fear and uncertainty drive rapid capital flows. Traders and investors react instantly to news, even before the full economic consequences are clear. That's why we've already seen a spike in gold and silver demand, as well as sharp currency fluctuations. Behavioral economics explains this. Humans are wired to protect wealth when uncertainty rises, and tangible assets like metals or land feel safer than paper-based instruments, which can lose value if a currency depreciates. In a world of digital finance, where numbers on a screen dominate perception, returning to physical stores of value is both practical and symbolic. Another angle worth exploring is the historical precedent. The US dollar hasn't always been dominant. Before World War II, the British pound ruled global trade, with gold reserves and colonies underpinning its power. The transition from pound to dollar dominance after 1944's Bretton Woods Conference created decades of stability. But it also relied heavily on agreements with oil-producing nations. The Saudi move is reminiscent of past shifts in reserve currency power, where economic influence and geopolitical agreements realign, often with years of adjustment. Understanding history can provide a roadmap for what to expect next, including potential winners and losers in this new financial era. Finally, consider the ripple effects across consumer markets. A weaker dollar affects imports and exports, commodity prices, and inflation. Oil prices may see temporary spikes or increased volatility, which can impact everything from transportation costs to heating bills. Industrial metals linked to energy production could fluctuate, affecting construction, technology, and manufacturing sectors. Even everyday products may see subtle price adjustments as supply chains recalibrate. Essentially, the end of the petrodollar is not just a headline, it's a chain reaction that touches nearly every part of the global economy. The long-term implications begin to crystallize, and one thing becomes clear: the world of finance and trade as we know it is entering a fundamentally new era. The immediate shock may fade as markets adjust, but the structural changes are profound. Countries will continue diversifying their foreign reserves away from the dollar, while investors increasingly favor tangible assets and alternative currencies. We are likely entering a period where gold and silver will not only serve as hedges but may play an even more central role in global finance than ever before. For example, nations with large gold reserves, like China, Russia, and India, now hold not just monetary security, but strategic leverage in an evolving world financial system. Their moves will influence commodity prices, trade negotiations, and even geopolitical alliances for decades to come. One key trend emerging is the acceleration of multi-currency trade agreements. With Saudi Arabia leading the way, other oil-exporting and resource-rich countries may follow, pricing commodities in euros, yuan, or a combination of currencies. This could fragment the global trading system, reducing reliance on a single dominant currency and creating new corridors of influence. Investors need to be aware that currency volatility is no longer a side effect. It will be a defining characteristic of the global economy. This opens opportunities for hedging through foreign exchange strategies, commodities, and, importantly, precious metals. Understanding these dynamics is crucial for anyone looking to protect or grow wealth in the coming years. Another aspect to watch is energy markets themselves. The end of the petrodollar does not reduce oil's importance, it enhances it. Oil remains the lifeblood of the global economy, but now producers have more negotiating power to dictate terms that are advantageous for them. This could lead to new pricing mechanisms, greater regional energy trade in local currencies, and potentially higher energy costs for dollar-dependent economies. The ripple effects extend to everything from airline tickets to industrial production, making energy market literacy more important than ever for investors and consumers alike. Knowing how oil pricing interacts with currency valuations can be a powerful tool in predicting both short-term market movements and long-term financial trends. Precious metals will continue to respond to these shifts. Historically, gold acts as both a safe haven asset and a monetary benchmark, meaning its price often rises during times of financial uncertainty and currency devaluation. Silver, with its dual role as a monetary and industrial metal, provides leverage to this movement but can be more volatile. Investors should consider a balanced approach, combining physical ownership, ETFs, mining stocks, and futures to position themselves effectively. The key is not just owning metals, it's understanding why they matter, how supply and demand affect pricing, and how macroeconomic shifts like the end of the petrodollar influence their long-term trajectory. Digital currencies and central bank digital currencies, CBDCs, will also play a growing role. As countries diversify away from the dollar, many are exploring government-backed digital alternatives that can settle transactions more efficiently across borders. These digital instruments could complement gold and other reserves, creating a hybrid system where metals and digital currencies coexist as pillars of global trade. For investors, this represents both risk and opportunity, the risk of obsolescence for traditional instruments, but the opportunity to engage with new financial products that could redefine liquidity and value. Storage in a post-petrodollar world. Let's not forget the human dimension. Economic confidence is intertwined with perception. When people see Saudi Arabia, the world's oil powerhouse, moving away from the dollar, it challenges long-held assumptions about stability and trust in traditional currency systems. Markets respond not just to fundamentals but to sentiment, and sentiment can swing sharply in times of uncertainty. This explains why gold and silver have surged even before the full implementation of multi-currency oil trade. Investors, both institutional and retail, are seeking security in tangible assets that have withstood centuries of economic upheaval. Finally, the geopolitical landscape will evolve alongside the financial one. U.S. influence may face new tests as global powers recalibrate alliances and trade agreements. Regions such as the Middle East, Asia, and Europe could see a rebalancing of power as economic independence becomes more attainable without dollar dominance. For everyday investors, this means paying attention not just to numbers on a chart but to policy decisions, international agreements, and global macroeconomic trends. The end of the petrodollar is a reminder that money is never just money. It is power, strategy, and foresight, all rolled into one. In conclusion, Saudi Arabia's historic move to end the petrodollar has triggered a $7 trillion shock that is reshaping the global economy. From currency valuations to commodity pricing, from gold and silver, demand to geopolitical realignments, the world is entering a new era of financial complexity. For investors, understanding these shifts, protecting wealth with tangible assets, and staying informed about global trends is not optional, it's essential. This is a once-in-a-lifetime realignment, and those who grasp the mechanics behind it will be best positioned to navigate the turbulence and seize opportunities in the new financial landscape.